Well, hello everyone, and welcome to this week's version of the Multifamily Investor Nation webinar. We're so excited to have you here on this Tuesday. It's election day, so hopefully you've gotten out there and voted, and if not, that you're going to plan on doing that today. But we've got a great topic for you in terms of our discussion. It's your assets needs. Your asset needs a capital call. What now? So again, my name is Rob Gallo. I'm the Director of Investor Relations at PassiveInvesting.com. Chad Zdenek is joining us here for one of the first times since joining PassiveInvesting.com. He's the Manager of Strategic Investor Partnerships here at PassiveInvesting.com, and he's really going to help us go through what happens when your asset does need a capital call and what other pieces you need to be considering on those items. So again, if you want to learn more about us and in Multifamily Investor Nation, we do have Multifamily Investor Nation channel on YouTube. If you want to see any of our deals with the underlying PassiveInvesting.com items, you can visit us at PassiveInvesting.com today. So let's go through the agenda here real quick that we're going to cover. So obviously, we'll quickly go through some of the introductions that we have. There's a lot of questions that you have when there is a capital call, and Chad is going to kind of walk us through either from an investor perspective or also from a multifamily investor. So we're going to go through those. Then we're going to talk through kind of what the process is. That not only from an investor perspective, but what you should be doing internally. So if you're a syndicator, or if you're an operator and you're pondering this, what are kind of those things that you need to make sure that you're doing as part of the process? And then Chad's going to walk us through a Long Beach case study that he has some personal experience in. And then we'll just take some time to answer general questions. So again, if you do have questions, please put them in the Q&A box. We do have some general statements that we put into into the webinar chats. You can check out some of our Facebook group there, as well as our investments. With that said, let's kick through introductions. I'll go quick here since I've been talking the whole time. So again, my name is Rob Gallo. Previously, I was a consultant for 18 years. I have been an active and passive investor. Actually, that's 13 years now. But really kind of switched over. That's my family there. Really switched over out of consulting into full-time gig here at PassiveInvesting.com. I had been an investor with them for a lot of years on this. And I just really, respected the group. I respected Danny and Dan, and really wanted to change kind of what I was doing in my life and really focusing on that. So I joined the firm, and it's kind of been, not smooth sailing ever since, just because of the economy that we've been in for the past year and a half. But we're working through it, as I think a lot of syndicators and operators are. So I'm going to stop talking. Chad, why don't you give a little background on yourself?
Okay, perfect. Yeah, thanks so much, Rob. Super excited. Yeah, Rob and I kind of similar paths, believe it or not, where we'd been investing with PassiveInvesting.com and realized, what a great company it was, and then wound up joining forces. I'm actually newer to PassiveInvesting.com. I just joined a couple months ago, but I'll give you a little bit of background about myself. I'm a GP in about $150 million worth of properties in multifamily and self-storage. That consists of 22 properties in 5 different states. I'm a licensed general contractor and professional engineer. And as Rob mentioned, I'm the manager of strategic investor partnerships for PassiveInvesting.com. That's my family there. I do have 5 kids, 4 girls. So it gets a little crazy around the house. But yeah, it keeps me busy for sure. I love it. So let's dive into this a little bit. And I wanted to go over a lot of info on capital calls. A lot of this I've learned through the school of hard knocks, just from various capital calls on my own, either as a GP or as an LP. And I wanted to start us off by looking at two different angles of the capital call, one from the operator or sponsor or general partner, and the other from the LP. Like the LP's got to figure out their own questions, right? So we'll start with the operator first. And I like to kind of start with like the questions that the operator should be contemplating, right, as they're getting into the need for a capital call. So the first question is what are the options in lieu of a capital call, right? Nobody really likes to do a capital call. A few years ago, it was unheard of to have a capital call, extremely rare. Today, it's actually pretty common. So it's a lot of things to think about on trying to avoid it, right? And some of those things could be a promissory note, member loans, bringing in outside equity. These are probably the top three things that I've seen as things to avoid a capital call. And I'm assuming that you've done everything to increase revenue, decrease expenses, all that stuff, operationally run the property as efficiently as you can. I'm assuming all that's been done, right? And now you're getting to where the rubber meets the road and the property needs more money. So these are some things that you could look at to try to avoid a capital call. And we're going to go into this a little bit more when I get into the capital stack on how these each play out. Another question is how are the capital calls handled per the operating agreement? Some operating agreements really spell it out in detail and almost like a step-by-step approach of what needs to be done. And other operating agreements leave a lot of leeway to the operator to decide how to handle capital calls, right? Either way, that will be spelled out in the operating agreement. So you'll definitely want to know what exactly you've signed or how you've created your operating agreement and what your LPs have agreed to. You want to know if there's any voting required for anything that might be needed during a capital call. And then of course communicating with the investors to make sure they know what those votes are. You'll also want to know what are your other plans you could do, right? Like what if you have to do a capital call and it doesn't work out or you don't get what you need? What's your plan B, C, and D? You'll want to think of these ahead of time because your investors are going to ask you, okay, what happens if we don't get all the money, right? And then it's really good if you know, okay, well, if we don't get the money, this is the next step, and then this is the next step, and then this is the next step, and we'll talk about that a little bit more further down the road here. But you definitely want to know ahead of time what those options are. You'll also want to know, okay, what's the investor sentiment for a capital call, right? This is where continued communication is key. Rob and I are intimately aware of this as part of the investor relations team with PassiveInvesting.com. This is where you need to be having a lot of calls with your investors to know what their sentiment is. If they haven't known what's been going on with the property, they're probably not going to be inclined to invest in a capital call. When they don't know, right? A confused mind doesn't make any decisions. You could also have capital call fatigue, as I like to call it, where you could have investors that have gone through several capital calls, right? We've kind of gone through this wave over the last 18 months where like initially when people were going through capital calls, it was like shell shock. People were like very, very surprised. Like, what? There's a capital call? Like we haven't had a capital call in 15 years. So people were really shocked and surprised. And then more people started having capital calls and they realized that it maybe had less to do with the operator and more to do with the market, more to do with interest rates. So they started to be a little bit more understanding of capital calls. And then after people have gone through a capital calls, you get experienced investors and they could have had 3, 4, 5 different capital calls on their portfolio. And all of a sudden they're like, hey, I've been investing in these capital calls. I'm out of capital. I'm tired. I can't do any more. Right. So they might believe in the deal, but they've done too many capital calls at that point. So that's what I like to call capital call fatigue.
Chad, it's so interesting on this because I think, and I know you're going to go through a few of these other pieces about like what to do, but to your whole point about if you're not communicating with, from an operator's perspective, you're not communicating with your investors what's going on with the properties, and kind of giving them some leeway to understand what it is. I mean, obviously, no one wants to say, hey, in 6 months, we might have to do a capital call. But one, you should make sure that you're communicating those pieces. But the second thing, to your point, is understand how your investor group is actually being treated, because maybe you guys are kicking butt and it's your first capital call and there's not a problem and you're like, oh, this is going to be great, like this is a great asset, like we don't see what the problem is. But if all of your investors had 8 other capital calls that they've had to make decisions on, that might be tapped. So it's just, good points on those, and just interesting to think through those.
Yeah. Yeah, exactly. So these are the questions that I think the operator needs to be thinking about. So let's turn the page to what the investors should be thinking about, right? Or what they should be asking. Now, this will be like from the LP standpoint. First off, again, how are capital calls handled by the operating agreement? This is what you signed up for. This is in the PPM documents that you would have signed, and the operating agreement is going to dictate those details, right? You're going to want to ask and know, what are the uses for capital, right? This is really, really important. The number one question that investors ask themselves is I don't want to throw good money after bad money, right? That's critical for investors thinking about doing capital calls. So you want to know, like, how are they going to be using the capital calls? What's the plan? What's the pro forma look like going forward, right? How is this capital going to get us out of the situation that we're in? You'll also want to ask yourself, how much of my investment's at stake? What happens if you don't do the capital call, right? Are you going to lose 100% of your investment? Are you going to take a 10% haircut? What does that look like? How much is really at stake? This is going to help to drive your decision. You're also going to want to ask yourself, okay, what other options do I have for my capital call or needs, right? Are there other properties that you might be having a capital call on that you feel more comfortable in, or you feel more optimistic about, and you'd rather put your capital call money towards that property, right? Or the capital you're sitting on, is it something else that you could, let's say, invest in a distressed deal or invest in a distressed fund and get better returns because you're putting your money to work and at a priority on the capital stack? There's a lot of different options for new money right now. And there's some blood in the streets, and we know when there's some blood in the streets, there could be some good returns to have, and maybe your capital is better served in those areas, right? So I like to think of those as the opportunity cost, right? And obviously the capital call is another project. These are the things that the LPs should be asking about. So let's go ahead and take a look at the capital call process, right? And this is going to vary a little bit. So I try to capture a lot of different things that I've seen in different capital calls, but just understand this isn't like a one size fit all. This could vary a bit, but generally, the GPs are going to want to calculate the current and future capital needs. You got to know what you're dealing with, right? And the key part here is the future capital needs. You got to know, again, looking forward, how is this really gonna help protect the asset? And nothing's for sure. These are all investments. There's risks, there's unknowns, right? But you might want to be talking about what are the assumptions that you're making to come up with the capital call amount that you need. And I probably should have put in here also like past capital call needs, because you could have some CapEx that's been put on hold. You could have AP that's built up, your accounts payable where that you owe vendors, right? That could have grown over time. So there could be some past needs that you need to settle up on. Again, you're going to hear this a lot. Communicate with investors. This is key. Ideally, this has been done throughout the entire process. But once you do know what the capital call needs are, you're going to have to communicate that with investors. And this is where you do need to start getting sort of formal with what you're doing. I've seen non-binding ballots that go out just to kind of gauge the interest of the group, especially if it's a larger group, where it's a little tougher to know what everyone is thinking all at the same time. You could do a non-binding ballot to find out what their interest is, right? You've got to lay it out. You got to lay out why you need the capital and what it's going to be used for. But a ballot can help you do that. You'll need an official ballot if there's proxy voting and things of that sort. You'll need to know exactly who's voted and who hasn't. Invariably, there's going to be some people that don't reply, but you're going to need to know what percentages of your people are in support of the things that need to be passed. And some things, not everything needs to be passed. Some of it's already explained in the OA. Other things give the managers discretion and they decide it for the group. But if you do need to know, if you do have proxy voting, you do want to collect those ballots. And then you want to collect your wire transfers and document participation. This is key because people that aren't participating in the capital call, they'll be what's called diluted, which means that their percentage of equity ownership has gone down because they chose not to participate in the capital call. And you want to keep in mind that the GP should be prepared to cover a reasonable shortfall. I was in one capital call. It was a $3 million call, and the shortfall was 2 million. I wouldn't really say that's a reasonable shortfall for a GP to cover. But I was in another capital call and it was only 200,000, right? Okay, that's probably reasonable for the GP team to cover. I understand reasonable is subjective, but understand that there very well could be a shortfall, and the GP team's got to know how they're going to be handling that. You're also going to want to update your cap table and org chart if needed. Like I said, if people aren't participating, they'll be diluted, and that needs to be documented. And then future distributions are going to be affected by those percentages. Lastly, you're going to want to execute and don't ask for more money. This is a pretty critical piece. You really just want to rip the Band-Aid off, as they say, get everything you need in one capital call. I have not seen it work out well to do it in phases. A lot of that seems like a bait and switch for people. If you say, okay, we need $1 million now, and then you're going to need $500,000 in 6 months, you need another million in 2 years, like that's not going to work out really well because people are going to say, I already gave you money. I'm not going to give you more money. Hopefully that all makes sense.
I think like right on the head there, the last one, that's one of the questions that investors always ask. Is there going to be a future need that you're not accounting for?
Exactly.
And honestly, it's short-sighted to not think like that and not share that, because that, again, that comes back to that transparency and communication with the overall the overall asset and what that potential hold period could be too, because you need to be thinking through those pieces at this point.
Yeah, exactly. So just a quick pause here. Next section is all the case studies. You want to take any questions now, Rob, or should I continue on with the case study?
Why don't we see if there's any questions that currently haven't seen anyone come in, but if you have any questions, please enter it into the Q&A, and we could probably just pause Chad here as he goes through. But why don't we kick into the case study?
Okay, perfect. So yeah, so we'll go into a case study here on one of my Long Beach properties. This is a small property, only 10 units in Long Beach. You can see some before and after pictures there that we did a fairly heavy remodel job on this property. We had a $1.9 million loan, which was fixed for 5 years. And then it turns to a variable loan with a 30-year amortization. And we had 3 years of IO. We had a $850,000 raise on this. And I kind of wanted to track the life of this property because you can kind of see some hints on where we might realize some distress with the loan. Hindsight's always 2020. And I think this loan was originally a 4.1% fixed for 5-year loan. So let's take a look at what I mentioned before, the capital stack. And this is really important to know where your money lies on the capital stack, and hopefully you're familiar with it, but generally the senior debt will be at the bottom of the capital stack, which means it has the highest priority. And then you have any mezzanine debt or pref equity, and then you have common equity at the top. So, and generally speaking, your highest priority position or lowest risk will have the lowest return, and your highest risk will have the highest return. And I broke this out just to kind of explain the different pieces with this particular example we're going through. Now, the green is all the same level and the blue is all the same level, but I broke it out just to kind of talk through the story a little bit. So we had a $1.65 million senior debt down here. And then they gave us what's called an earnout of $225K. The earnout can be for different things, but it's basically when you hit different benchmarks over time, then you get additional loan, and it's already been negotiated. You know what the terms are, but the bank does not release those funds until you hit those benchmarks. For us, it was getting through a large portion of the rehab and showing that we could get the rents that we said we could get, and then they increased the loan amount by 225K. Now, even though this money came later, it's still senior debt. It's still the same exact priority, the same returns. It's calculated the same. I just wanted to break it out to kind of explain that a little bit. The common equity, like I said, we had an 850K raise initially, and then we're going to have a capital call of 215K on this property, and that's going to be equity as well, same level. Now, before, if you remember, I said, okay, what options do you have to a capital call? And I mentioned you could do member loans, you could do promissory notes, you could do outside equity. Generally, that all those things would fit in between the blue and the green box right here. So that would come after the senior debt, but before equity is where those pieces would land. And in terms of priority, when any distributions happen or the property is sold, these buckets are filled first, right? Hopefully you have enough to fill up all the buckets, but if not, wherever it stops, it stops. And those inserted pieces would go right in the middle here. So let's take a look at this a little bit more, just so you can kind of see what happened. So we had average rents at purchase of $1,575. Current rents are at $1,990. That's pretty good, right? With an NOI increase 25%. So that's pretty good. That was like in a 4-year time frame, and not bad, right? And then we start to hit some issues on debt servicing, right? So the first 3 years in IO period, the servicing is always lower there, right? We're at 6,500. But then the last 2 years, once we go to fully amortized, we go up to 9,200, right? Now this was planned on, right? We knew we were going to be taking a hit there, if you will. We thought initially when we purchased it, we thought you could be an option to refinance. Not that we would, it could be an option, right? But once rates went to where they went to, that was no longer an option on the table. Which is okay in this example, just because we were planning on going fully AM anyways in the situation that we did not want to refi. So that's not the issue. The issue starts to happen here, where you run into the floating rate, meaning the 5-year fixed rate ends. Now, this is where you get hit with today's interest rates. And now you're at over 14,000 per month on debt service. And this is, as you can tell there, this is about a 50% increase from where we are right now. And debt service typically being your largest expense, and you have a 50% increase on that expense. This is the main reason why so many properties are having capital calls today, because of this one small bullet point right here. This is what's causing a lot of heartache for a lot of operators. So what options do we have? We could sell the property today. It would be about a 40% loss to investors, right? Not a very good option. They do get some capital back. You know, there's been a lot worse situations where investors lose everything. But it is a loss, not good for anybody. We could keep the existing loan and deal with the fully amortized section of it, but that's a problem because then we're cash flow negative. We're still going to have to deal with the cash flow shortfall on a monthly basis. That's a challenge, right? Like I mentioned, our payments going from 9,200 to 14,200. That's a big increase. We could do a cash in refinance, right? We're all familiar with cash out refis, right? That was the name of the game. Now it's more common to do a cash in refinance, again, to get down into a fixed rate product. And we could do that, and our monthly payment would actually decrease down to 8,100, and the property would be cash flow positive, right? So pros and cons here. We become cash flow positive. We're at a fixed interest rate, but we got to put some money up front to do that. The fourth and final option is you could bring in outside capital, right? There's a lot of projects are doing this. In this example, this is too small of a deal, frankly, for outside capital. It's too expensive and too small of a deal. So that doesn't quite work out. So let's wrap this thing up here on investor sentiment and reaction. Right. Again, this is a real case study. So I've got about 10 investors on this deal, and most of them are comfortable with the capital call, and one's not. So I need to figure out, okay, what are we going to do with that one investor? You think of it like 10%, right? It's probably a good number for a lot of healthy projects that just have distress due to interest rates. You could probably expect to get about 90% of the people that will support it. But you got to figure out that 10% shortfall, right? For us, the best path forward, we are looking to do the refinance, hence the capital call. I kind of spilled the beans on the investor reaction. We're doing a cash in refinance on this. We think that we could sell the property in a couple years as interest rates trend downward and cap rates trend downward. Your GRMs go up. We think that we could sell this at a decent profit in a couple years. So we're looking to do a 5-year fixed loan. It's going to be cash flow positive from day one, but it's going to take some money to go forward before we can do that. So at this point, Rob, I'll give a pause. That's the end of the presentation officially, and just open it up for any questions that people may have.
Well, for Chad, thank you again for sharing and taking us through this case study. I think, for folks on the phone, be it, if they're LPs or if they're syndicators, or general partners, they can obviously learn a lot from this, and the specific details are extremely important on that. We'll take questions in a second here. I'll give you some time to write in. But I just wanted to thank everyone for joining us today in the Multifamily Investor Nation webinar. Please join us next time. The topic will be a really multifamily forecast for 2025. So our asset management director will be joining us for that, and kind of taking us through what, kind of the top markets look like in the multifamily area, as well as, the debt outlook and some acquisition strategies that we'll be talking through in that next Multifamily Investor Nation. That will be, it looks like, December 3rd at 11 a.m. So next month on that. Are there any other questions that we have? Okay. Well, again, thank you everyone for joining us. Chad, thanks again for sharing so much information, and really appreciate your time on this.
Sounds good. Thanks, Rob.